This is Martin Porter, Step One Finance, somebody I have known for many years, since I believe I first met Martin probably about 1986. I think it was 86, maybe 87, not quite sure. You should have received, everybody, this in the post of, and also via email this morning, which is Step One's summary of secured loan products. It's a double-sided document. So please grab that, just so you've got that to hand. So when Martin's going through certain things, you can actually refer to that. A little bit about Martin. This is the first one Martin's done, by the way, so please forgive me because I've not actually learned this one like I have some of the others. So Step One was established in 2010, operate an industry-leading consumer finance platform built on traditional lending values. I won't read all of this, by the way, because it's quite wordy. I'm just going to tell you a little bit about Martin for those of you that can't actually see the slides, because that sometimes happens. Martin's been head of lending at Step One since 2013, responsible for all aspects of lending, which includes second charges, bridging, and unsecured loans, but currently only second charge loans. He leads a team of experienced underwriters dedicated to delivering operational and service excellence. Martin has over 30 years experience in the UK residential mortgage sector. Prior to joining the Step One team, Martin was working as a consultant to a leading law firm on mortgage regulation under the FSA regime, and also to a specialist secured lender. From 2002 to 2011, he was head of lending at GE Money Home Lending, which some of you might remember as iGroup, with nationwide responsibility for all first and second charge residential mortgage lending. He basically was the guy who signed off the cases. Prior to his time at GE, Martin held various positions, head of lending, acting as an underwriting supervisor with, I've already mentioned, iGroup, City Mortgage Corporation, and this is where I first met Martin, Heritable Finance, or as they were known, Homestead Finance, as their trading style at that time. And Martin's interesting fact, or not so interesting fact, he has nearly been in the industry as long as I have, apparently. I'm not quite sure when he started, but he has almost as long as I have. And he's possibly the only person to say no to one of the Maxwell family. He rejected an application from Kevin Maxwell, apparently, allegedly, I'll say for the benefit of that.
Yeah, can't say. DPI regulations are certain, yes. Right.
Yes, absolutely. Although he did lend millions to Robert Maxwell, but anyway, that's another story. Okay, so what we'll do now is I've just one more slide to go, which is this one. Just whilst I put Martin's presentation on. And then, Martin, I will see you very shortly.
Next.
Bear with me 1 second.
Here we go.
Okay, over to you.
Okay, good morning, everybody. Thanks so much for that, Tony. Let me just go straight into what I'm hoping to cover this morning. Past this bit. So I'm going to do a bit more introduction on Step One, because some of you may not have heard of us. We are, I guess, one of the sort of smaller, medium-sized lenders in the second charge market. Then we're going to go through some criteria highlights, which will touch on the product guide that Tony sent out. Look at some of our USPs, of which I like to think we've got quite a few, especially at the moment. Cover our income and affordability service, which again is a little bit different and has some pros and cons. Also cover our adverse credit assessment, which again I think has got some interesting aspects to it. A touch also on our current COVID criteria, where obviously there's a lot of turmoil in the market, as Tony's mentioned, and where we've tried to be as clear as we can what our criteria there is, and then a couple of case studies to help you as to cases that we've done which are outside our criteria, because we do have that ability and look to do that. So I shall move on as we are. Okay, some of this Tony's mentioned about Step One. I guess some of the major points here are that the management team that we've got here, as you may not know, got our directors, Mike Childress, over 20 years working with Morgan Stanley. One of the directors was a guy called Jeremy Masden, who helped set up Central Trust. And obviously there's myself and the other city managers who've got a wealth of experience. So we obviously got a lot of experience in consumer finance, and I think in the current climate, that's really important, where you can actually apply that experience to all the difficulties and challenging situations we have at the moment. We have products covering second charge, as Tony mentioned, buy-to-let, bridging, and unsecured lending. The two areas we haven't carried continued lending is bridging and unsecured, mainly for sort of like unsecured for obvious reasons. Bridging, we'd only delved in that market, so we felt a bit more comfortable pulling out of that just in the current climate, really. In the sense of our funding partners, we've got some pretty large institutional funders. Some of our partners are PIMCO, which you may have heard of, LCM, and Credit Suisse. So we've got some good, very large institutional lenders behind us, and we've not stopped throughout this whole period. We had a slight change of criteria for a couple of months, but we've carried on lending, and we see no reason why we won't continue lending through this period and beyond. We also, I think, which Tony will concur with, we have a pragmatic approach to lending. We are able to be flexible where we can. And obviously, as I said earlier, in the current climate, it's really important to be able to look at the cases in that sort of, with that view, with the different situation that you can get in respect of, people's personal circumstances, furlough, not furlough, loans from the government, etc. So we look at those individual and try and apply some common sense to that. And also, in part of that, we also, there's access for our partners, intermediaries, to have access to the underwriters. Most of our underwriters are now back in the office. We have a couple of furloughed people, but majority of them live fairly local to us. So most of the team are actually back in the office, obviously social distancing. We currently only have one BDM available, with the other two on furlough, although he's currently selling himself in Spain, so hopefully he can get back. But so obviously, to Tony's point earlier about access, team here, anybody can access to myself and the other senior members of the underwriting team, which I think, again, is really important at the moment. In expense criteria highlights, hopefully you've had a chance to read our product guide. We like to think that it covers a wide product range, covering, if you like, all aspects of second charge lending, from your status clean customer to customers with potentially old historical problems, maybe current credit problems. And obviously, we have a range of rates. It's obviously fair to say we're not the cheapest. You can see we don't look to compete with the likes of Optimum and Paragon, if you like. But we do have a range of products from up to 85% LTV. And we can offer loans up to $500,000. Our standard loans 150k, 100k in buy to let. But so those are the overall areas. We think we're probably round about now sort of 15 to 18% of the market, mainly because obviously, unfortunately, some lenders have pulled out, and obviously the market's contracted substantially. And we are picking up quite a lot of cases from other lenders for whether they pulled out or whether they don't fit anymore, or people are more strict in their criteria. So we like to think, and obviously we've done this in conjunction with Tony's help, got a product suite that we think covers a lot of aspects of second charge lending and does appeal to intermediaries, especially in the current climate, to try and place, I guess, difficult, complex cases. Obviously, we have a range of evaluation with AVMs. We do it to quite up to 80% LTV, and we also cover acquittal charges. So I'd like to think that the product guide you've got covers aspects. Obviously, it details our rate structures all the way up to 85% for residential and 75% for buy to let, which I think is probably one of the most competitive in the market, or probably the most on loan to value on second charges anyway. So that's what we try and do at the moment, and it seems to be appealing to the intermediary market. If we go to basically looking at the UOPs which are part of that criteria, as I mentioned, we do go to 85% on residential, with potentially some adverse credit. Obviously, in the current climate, we're a little bit hesitant to do too much of that LTV, but you can have some slight adverse if you like on that at £150,000, which is quite popular. Although I must say that our average LTV is still around about the 65% mark, so that's quite encouraging. We're not seeing too much adverse selection, if you like. Buy to let up to 75%, which I think is quite competitive. Again, potentially with some adverse credit, and again up to a standalone 100k. But on both those areas, we are able to go above those levels, and we do on a not a regular basis, but where the deal makes sense. So we'll come to some of the actual case studies where we've managed to do that. So as I say, the adverse credit plans across all products and LTV bandings potentially. So there's lots of advantages there and opportunities there as well. We don't credit score, as you can probably see from the product guide if you have it there. We have an adverse criteria that applies to on a units, if you like, and we don't actually credit all per se. So that's one advantage where it gives us the ability to be more flexible on cases. We're looking at people's current and previous credit history. Also, we do equitable charges up to 80% LTV, and even on buy-to-let, 75% LTV. Again, that's quite popular. I think we probably do about 25% of our loans on equitable charges, which we have no problem with, and that's quite good. It's not too bad in respect of getting consent, although it does take a while these days. But we do have obviously instances where it's not applicable, especially on buy-to-let, that won't grant consent. So that's quite a popular product. And just the information in respect of the old adage that equitable charges were obviously more difficult to get repossession. Obviously, that's somewhat irrelevant in the current climate. But even now, it's when prior to this, it was just as easy to take any legal action as it was with formal legal charges. So we don't have a problem with that. We also have a unique product in respect that we can lend behind equity release first mortgages. There's obviously some LTV restrictions in the sense of that. But again, it's there. It's an opportunity where customers maybe still have the ability, have income where they can actually borrow second charges. There's obviously some issues regarding consent from the equity release companies, but obviously that's a situation where the advisor will get involved in that situation. But again, it's a unique product, but it is popular in some circumstances. In respect to purpose of loan, we're fairly flexible. We'll consider most legal purposes. We do quite a few cases, people buy to let purchases, tax bills, transfer equities. So sort of maybe odd situations that other people aren't more comfortable with. And certainly buy to let it's fairly popular at the moment. What we really need from that is confirmation of what property they're buying, and maybe if they got an offer from the first mortgagee, or maybe a quote or something like that. But so that's quite popular. And on property types, we're fairly flexible in respect of types of property, provided the LTV, the security is adequate for that. And then finally, AVMs, again, I think quite competitive at 80%, loan size 75k, property value 750k, only on residential. But again, that's quite popular. It was obviously very popular a few months ago where the values weren't going out. And even now, there are certain sectors where there isn't great coverage for valuers. So it's quite a good processing tool, and obviously it's a lot cheaper than spending a few £100 on a valuation. So again, I think a lot of those USPs are important in the current climate, and again, I think they back up our product range, which covers the whole aspects of second charge lending, and I think currently in the climate they're proving very popular. In respect of income and affordability assessment, we have, again, I think some good USPs. We don't have any debt to income ratio limitations. Obviously, we do look at that case, when it's 6 times or greater, we look at that, but we have no set criteria around that. So that's quite a good opportunity for you. In respect of expenditure levels, we don't have any strict minimum default levels, if you like. But obviously, the underwriters internally will look at the declared expenditure and compare it to ONS figures and make a value judgment against that. In that respect, we have a fairly simple standalone income and expenditure calculator, which is very easy to understand, very transparent. And also we have a minimum financial credit obligor you would expect. In the areas what income we'll take, again, we're fairly flexible. We will take overtime and bonuses for most occupations where we can see that it's been earned previously and we expect it to be earned in the future. We are also doing quite a few contractor cases for whether they're financial contractors, IT contractors. We do ask some additional proofs of the contract and future employability, and a little bit of strict affordability assessment. But again, it's a fairly popular one, and I guess maybe some lenders don't have the appetite to take on these customers at the moment. But I think maybe going forward, it's a good opportunity to everybody. Self-employed applicants, again, we're fairly open to most occupations where we can see that they are now earning money, whereas even though they might have had 2 or 3 months off from furlough or the market. So anybody with the latest bank statements who can verify their income at the moment, we'd be more happy to lend to. We also consider most types of benefit income as additional income, where there is employed income for 1 or 2 of the applicants. I guess the slight downside is on buy-to-lets, where currently we don't do any rental coverage, and we need a full affordability assessment like on residential cases. I think that's twofold. Firstly, obviously in the current market, there's a lot of tenants not able to pay rent, so we're not sure where we're comfortable all the time doing that. And also, a lot of the first mortgages is interest only, and as we apply stress, then the rental coverage is quite often doesn't cover it for 130%, which is what we used to require. So again, it's not a great positive, but it does give opportunity for cases where the rental coverage may not be enough, or they've got voids or something where landlords or people with one or two buy-to-lets can apply to us to get that. And again, we good at 75% LTV is quite a good aggressive figure. So in affordability, again, we like to be fairly pragmatic and sensible, looking at each case and its own merits. And certainly we've picked up a lot of cases where people have come out of furlough, whether they're employed or self-employed, and we're able to apply some common sense underwriting there. Adverse credit, obviously people's appetite, lenders' appetite is somewhat a bit lower than it used to be on this respect. But as I mentioned, we don't credit score. We do look at unsecured credit, so we do look at their payment history on those. We do have a sort of, I guess, a medium adverse plan, if you like, at 4+ units, potentially for those customers where we think that they've either had problems and we can see that those problems have gone away. It's fair to say, look, our average unit on cases is less than 1. So while it's there for the right case, we don't write an awful lot of those cases. So it's just opportunities where people, maybe they did, have gotten a new job and had a void of employment for a while. We've got opportunities there to lend to those people. We will look at cases from people who are in a DMP or an IVA up to 85%. We do need to look at the conduct of those IVA or DMPs. And the DMPs, again, the opportunity is there not to repay that, but obviously we'll take the DM payment into the affordability criteria. Again, that's quite popular. Obviously, a lot of people either are in DMPs, may have been missold DMPs in the past, and maybe have a few years. And obviously, from the applicant's perspective, it may be the best way for them to keep that DMP going. So that's ability there. Again, respect to flexibility, we are able to be flexible here on criteria. Our portal has the opportunity where every case that doesn't quite fit on credit or other aspects is referred to the underwriter. So they have the ability to approve the loan or decline the case where they think where it's actually outside criteria. But if they think it's got merits, then they cannot proceed, even though it's got slightly more adverse than our criteria lies. And obviously, again, in the current climate, that's a great aid for us to have. So we think that's a good plus on our portal system, which I think most brokers do actually appreciate. Obviously, we've got some direct COVID criteria here for obvious reasons. But again, it's where we think we've had to go and be fairly open and transparent on what we will and we won't accept. We are learning for this, all the circumstances become, there's different cases every day that come up with different circumstances, which we try and take on board and learn from. We have to make sure applicants are back from furlough and we need their return to work. But as long as they've gone back to work and we get evidence of that, we're more than happy to take these people on board. There are obviously restrictions for certain sectors where we are, less comfortable at lending, and we are obviously mindful of that and apply that sort of common sense lending in those respects. Any payment holidays must have finished, and we will need confirmation from any mortgage company that their payments have resumed. Again, as Tony mentioned, we've come across a number of cases where the people have just taken them because they can, and it's just though we don't explain because it's not our place to, you can tell they just took it because they want to save a bit of money, whatever. And obviously from our servicing team here at Step 1 has seen all the cases where people have actually taken it when they don't need to, and they're just taking it because they just feel like it. And obviously we try and cater for that. So provided they've gone back making their payment holidays, we're more than happy to lend to those people once we know that they made their next mortgage payment or it's ended. We also will happy to look at people who've had government grants or loans or bounce back loans. We see obviously a lot of self-employed people taking them because they can. They see it maybe as a saving, pay off a business loan at X% and they get this for a year with no interest, or they've taken it as a safety valve. Again, provided we can see that it's not too excessive, and we can also see that they are still earning properly, and it maybe it's just, as I say, taken for a specific reason, then we're again more happy to lend those people. But again, each circumstance can be different, and we're learning all the time about people's different circumstances. So there obviously is a full criteria available in respect of this area, and it is being updated constantly where we're learning the circumstances. So, but again, it's something where we like to think that we're open to talk to brokers about cases, and certainly there's a lot of liaison with brokers now about different customer circumstances, change of jobs, new jobs, different types of jobs, lower incomes, etc. Where it's great to have underwriters on board who can actually talk to lenders, talk to brokers about that. In respect of a couple of case studies, just to give you a flavour, I mean, obviously our standard loans are debt consolidation. Our average loan size is about 50,000. Average, as I say, adverse is about 1 unit or so. LTV is about 65%, which is good. But there are cases where we're able to go outside criteria, and we obviously have the authority and ability to do that. So you got one there where it's like 215,000, which is obviously higher above our standard loan, but the LTV was acceptable. The property was very good standard. The two issues we had was the one applicant was a contractor for financial services, but they were a qualified accountant. They'd worked, I think it was at Barclays for a few years, and the contract was likely to be extended, but we couldn't get any proof of that, obviously. But based on the applicant's previous history, the ability that we thought was good to get future employment, and obviously the LTV, and that we're happy to do that. And that was obviously quite a large loan for 215k, but obviously it was a good outcome for the customers as well. And the second one was, again, just an chance where we had to show our flexibility and help to the introducer. 96k, large loan usual, but nothing special about that. There was a little bit of adverse on it. One guy was self-employed, so that obviously we had up-to-date bank statements for that. The issue on this one where it was needed a speedy confirmation was that the case had an offer with Together. Unfortunately, that had been withdrawn, as we know, with Together, but sadly. And obviously, they'd already paid for a valuation, probably worth 1.1 million. Obviously, it cost them a few hundred quid for that. But we were happy to proceed on AVM, even though it's well outside our criteria, and approve on that basis. So where we looked at it, thought, look, we can see the property, and we couldn't get a copy of the Together valuation, but we're more than happy to proceed on AVM. So a couple of cases where, we guess went outside our criteria because the deal makes sense. So hopefully that gives you a flavour of the sort of thing that we're able to help people on. That's really covered my presentation. I haven't gone into much depth of some of our adverse credit calculation, but it's on the product guide, and obviously our portal would applies that criteria in full. And obviously, hopefully, that's giving you a flavour of what we can offer. And obviously, working well with Tony in the past, in the future, hopefully there's lots of opportunities there to use us via Tony and his team. Thank you very much.
One more slide, I think you got. Yeah, you have. There you go. Thank you, Martin. Absolutely bang on time as well. Very impressed for your first one you've done with us. We've got one question asked so far. Are you happy to lend to applicants that have returned from furlough but on reduced hours, or those that have taken a pay reduction during COVID?
Yes, we'd obviously look at the lending or basic affordability on their reduced hours. And that's commonplace. We have a number of those cases where people are on reduced hours. They've reduced overtime or bonuses, etc. So yes, we are happy to do that as long as we've got proof of. We obviously get much more up-to-date proof income now. The latest payslip, etc. Or bank statements, like self-employed, I guess. But yes, we're more than happy to do that. And it's a common occurrence, unfortunately, as my son well knows.
No, that explains it perfectly. I must admit, everyone that's listening, that is very, very different to many lenders out there who don't seem to have any sort of procedure in place whatsoever, or any common sense being applied at times either. What's Glenn said there? Unable to copy details on left as is an image. Okay. I'm sorry, I don't understand that, Glenn, unfortunately. Okay. I've got a couple of questions that we pre-prepare questions sometimes if we don't get asked in that we don't have any questions from the delegates. So, Martin, what differentiates Step 1 from other lenders?
Besides some of the products, I mean, obviously, you know, all lenders have got their niches and products, and ours, you know, ours has got some plus points in certain areas. I think things like loan to value, we're quite aggressive on, I think. And also, I to your point mentioned, which I keep barking on about, but, you know, we have access to the experienced underwriters, access to me, where we do look cases in a common sense view, and especially in the current climate where, you know, each circumstance is so different. It really is. I think so. There's those areas, and where we're flexible. We've got our products. I say we've got some USPs I mentioned. And so I guess they're the two areas I think I would concentrate on.
Okay. And second one we had was, how are you dealing with applications in the current climate?
Well, I guess we've covered that really, Tony. I think the furlough and I think we probably covered that. Can't think anything else to add.
I don't know who asked that question, by the way. It wasn't me. So I'm just probably going to say, well, as of tomorrow, all the step one documentation will be on our website, so we can send you a link for exactly where that's held. Should you need to download it, because you can, if you've got the right permissions, give the advice yourself on some of these cases or some of their cases, but we can obviously help you, and I'll cover all this a little bit later on in my second bit. For me, well, there's various reasons why we like step one. Obviously, Martin's already mentioned they'll take a second charge behind certain equity release lenders, which is absolutely unique. Nobody else is doing that at this moment in time. It is still quite tricky at times, but of course, the one good thing is that the affordability side of things is really doesn't cause a problem, because there isn't any repayment on the first charge. So that I can see is something that other lenders will copy once they get their head around it. It's something that I've been banging the drum for a couple of years that lenders should be doing. But so far, only step one have actually taken it on board. So that just shows really that they do understand the market, first of all. The fact they'll also take a second charge where consent has been refused. So if it's a buy-to-let behind the likes of TMW or some of the other idiot lenders out there who refuse consent for absolutely no reason whatsoever, other than quite often they'll just contact the client direct and offer them a further advance, or try and offer them a further advance and then refuse it. That is an incredibly handy product. Really is handy. For me, when Together withdrew from the market, it was, it left a massive gaping hole in the marketplace, which step one really have stepped into, if you forgive the pun. They really have proved invaluable. But the most important for me thing about step one is that, I've mentioned before that I've known Martin since I think it was probably around 1987. He and I have been arguing cases as a broker and lender since probably about 1989, when I started out on my own brokerage. And
we both think we're right, Tony.
Yeah, because I know Martin incredibly well. So first of all, if I don't speak to the underwriter, I don't know who the underwriters are at step one. If we have a case that's been a bit tricky, I'll just speak to Martin. He knows that we won't take the mick. He knows that we're not going to start screaming and shouting. We'll just go across with the facts of the case and, the good parts, the bad parts. If it's something he's prepared to do, then great. If it's something he doesn't want to do, then we try. But more often than not, you find, I won't waste his time with cases I think are a complete waste of time. And he will, the fact he's been doing this so long in the position that he's in means that he really does, it's really fairly unique in our marketplace. When it comes to making decisions on cases that not so much outside criteria sometimes, but something crops up that's a little bit tricky, where other lenders will say, "Oh no, can't do that." I'm sure. Some of the cases we've got at the moment that we're putting through. We had one case a couple of months ago where the lender was trying to find a way to decline the case, even though the client, his business sold PPE. And the lender was coming out of all sorts of nonsense as to why they couldn't do the case, because he was self-employed, but he sold PPE. His company sold PPE. If that case had gone to step one, then I'm sure we wouldn't have had any problem at all. Fortunately, I think they were slightly more expensive than the lender we went through, but it almost did go to them because the other lender were just being plain stupid, more than anything else. So I haven't got any other questions. Let's see if anything else asks. Vicky said, "I'm in Sesame, can we use you?" Yes, you can, Vicky. Vicky, if you contact me directly, I'll explain how you can do that. There is a way of you doing that, and believe me, if you are offering second charges, step one are a lender that you really want to have details of and be offering, because they are an excellent lender. and they are here to stay. The fact they've lent throughout COVID is a testimony to it. They've reduced criteria slightly, but not massively, and they were still offering stuff that others weren't. So for us, a great lender to have on board. Martin, I don't think there's any more questions. So yeah, Vicky, just message me directly, and you should have my email address actually. So just message me directly, and I can cover that with you. Martin, thank you very much. Very impressed. Your first presentation, so nothing went wrong. Your microphone worked, your camera worked.
I had a lot of help.
So you're not the technophobe that I thought you might be. So obviously maybe you're having some help in the background. I don't know. I certainly am. I've got a team around me who are helping me. Yeah. So, but Martin, thank you very much indeed. That was brilliant. So what we'll do now, we'll move on to our second presentation, and we'll add on the second speaker. So I'll just add on that presentation. Okay, so our second lender is Hampshire Trust Bank, and we have Sammi Gilbank speaking to us, and I'm just going to check to see if she's on yet. She is actually on, but she's not showing up. Okay, so you should have received, delegates, this in the post and by email, which is a double-sided document just outlining their specialist buy-to-let. And do forgive me, those of you that received the post, we forgot to include the bridging rates, which has been sent to you this morning on email. So if you haven't got it and you've got access to a printer, print it off, because they do have some very interesting bridging products, which Sammi's going to cover. So a little bit on, first of all, a little bit on Sammi. Started a career in financial services all the way back in 1995 as a secured loan clerk for First National Bank. Progressed through various roles over the years. She probably knows Martin Poulser actually, because First National was bought by GE in the late 90s. Various roles over the years, from administration to underwriting, has worked for other banks as well as direct brokerages on an advisory basis, and spent 10 years working as a packager. Seen many changes over the years, a variety of roles she's held has given her an all-round understanding from a borrower, broker and lender perspective. It's not all work. She has a passion for music, listening, not playing. Sammi goes to many live concerts, loves the theatre too, something she's really missing in these strange times. She lives close to the New Forest and has recently started cycling, which has certainly made her appreciate what's right on her doorstep. Lovely part of the world, where we quite often try and go on holiday, myself and my wife. So, and Sammi's interesting fact, and I did this last week, so forgive me for the image, but I just wanted to fill the screen up. Sammi holds a Blue Peter badge after appearing on the show in the 1980s as part of a dance school production being performed at a local theatre, and if we're lucky, she'll be wearing the Blue Peter badge today as she talks to us. So Sammi still hasn't appeared for some reason. I'm just looking at my team in the room with me as to see if they can find out what the problem is, because it was absolutely fine last week when she presented, also fine on Tuesday when we did a test run. So technology. Let's just get Sammi's slides up, so when she is ready to go. Oh no, she's gone. Oh, she's coming back. Okay, so there's Sammi's presentation, and hopefully as soon as we get her back, there she's come back in. Just before she comes live, just to advise you all, if you haven't come across Hampshire Trust Bank, they launched in 2016. I hope I'm not treading on Tammy's toes here with any of her presentation. Launched in 2016. Hampshire Trust Bank have been around for many, many years. They launched into the specialist finance market back in, I think it was May 2016. In 2016, 2018, 2019, we were the largest broker. And have written tens, and I do mean tens of millions, not quite in the hundreds of millions yet, but it's not far off with them. And they're found to be a very, very useful lender, that they have products and are able to do stuff that others can't do. So we now have Sammi as a presenter, but we still can't see or hear her. So we're just trying to sort the technical problem. So please bear with us. This is where I should have a short interlude of some music or something going on in the background, but we haven't thought of that yet. So maybe that's for next time. So she can hear and see us, but she can't. Yeah, for some reason it's not. Okay, what I might do, we might have to call her just to see what the issue is, and then so I'm going to mute my microphone just for a moment, just in case there's any swearing goes on in the background. So do bear with me 1 second. Right, apologies again for the delay. Sammi is hopefully about to come live. She can see spinning circles at the moment on her screen, which means what we have had to do in the past is actually we've had to phone the presenter, and they've actually done their presentation over the telephone, and I then click the slides as they've gone through them. So we'll probably give it another minute or so, and then use that as an option if we can't get Sammi on board. As I say, it's always the technical issues. So just bear with us 1 second. Again, apologies for the wait, everybody. So we're now, hopefully, we're remotely rebooting whatever Sammi's in at the moment. So that should then work. We hope. But I did test the technology, didn't I? Gets us every time. There's always something goes wrong. Doesn't matter how many times you test it, how many dry runs you do, to make sure everything works fine. It's very much in the hands of the software and also the internet signal. So what we're going to do, we're now about 5 minutes behind. So what I'm going to do, if we can get Sammi on, I'm going to ring Sammi. Sammi can change her own slides because she is actually in the system. But what I'm going to do is I'm going to ring Sammi, and she'll start her presentation over the phone. And then if we can get her to actually appear, then great. So bear with me 1 second. Oh yeah, okay, right. So I'm going to put you on loudspeaker so you can start the presentation, and then if we can get it working in the meantime, then great. Then we'll end the call. Okay, right? Okay. Okay, Sammi, you're on speaker.
Hello, everyone. Apologies for the technical difficulties. Maybe you can't see me today, so I'll just talk you through the presentation. As Tony said, I'm Sammi. I'm from Hampshire Trust Bank, probably more commonly known now as HTB. I represent the specialist mortgage division of the bank, where we specialise in non-regulated lending. As you'll see from the slide in front of you there, that basically covers the main areas in which we're lending at the moment. So we deal with specialist buy-to-lets, semi-commercial, and we also do a little bit of residential and commercial bridging. So what makes us a little bit different from our peers and other lenders in our space really is a very hands-on approach. So from cradle to grave, we are a manually operated lender, which means that from the dip coming in at the very, very start of the process, all the way through to completion, somebody actually has eyes on that application to review it and to make a decision. So what that means for you guys and for us is that we can then deliver service on slightly more complex cases. Nothing that we do is black and white. Everything we do is a little bit grey. We currently have a product range allowing to lend up to 15 million. That is per with us, and that could be a mixture of anything they want to bring to us in their personal name, as well as anything within a limited company. We can lend up to a 70% with arrangement fees being added on top, as long as, if we're looking at a buy-to-let or a semi-commercial, the rental cover covers the gross loan amount. We don't currently have a maximum age on our product range, so borrowers can come to us at any time. So there's no maximum age at DID stage and no maximum age end of term. We don't have a minimum income requirement, so therefore if you've got a portfolio landlord and they want to bring us their portfolio, or even just a couple of buy-to-lets, we don't have a minimum income requirement in the background, and we can basically look to work from the income generated from their portfolio. We only have 2 and 5 year fixed rates, so it's a very, very simple product range. We work on the 5 year fixed at pay rate in terms of the interest coverage. So majority of the business we do, because it's calculated on pay rate, is on our 5 year fixed products. So the types of borrowers that we're lending to, and again, this is probably what makes us a little bit different from our peers. So as I've mentioned, we do lend to portfolio landlords, any size of portfolio. If they're not bringing the whole portfolio to us and there's some remaining in the background, we do stress that at 125% based on a 5% pay rate. We can lend to trust and offshore companies. The offshore companies part, again, is what makes us very different. We don't have a specific range of countries that we'll automatically say no to. We do have a list. All countries are graded high, medium, low risk, and can even consider lending to some high risk countries, provided the borrower can actually meet our due diligence requirements. Individuals we can also lend to, so they don't have to be a portfolio landlord. Within that, you'll see it says they're first-time landlords. So if we are looking to lend to someone who has never held an investment previously, they must have their own residential mortgage in the background, and they must have a minimum income of 25k. If we're lending to portfolio landlords, they don't need to hold a residential mortgage in the background. We can lend to new SPVs, so we have no minimum time trading, and we can also lend to trading limited companies. So that's any trading company without the requirement for a specific SIC code to be set up in the background. And again, no minimum time trading. The expats and foreign nationals that you'll see there kind of falls in very similar to our offshore companies. So again, the best thing to do is contact specialists and ask them whether or not the country that the person is residing in or coming from is going to be suitable for ourselves. They'll just put in a quick call and I can check the list to see where we are at that moment in time. There's probably about only 4 or 5 countries at the moment that we would consider an absolute no-go. If it is a foreign national, we can lend to them either lending in the UK, they don't need to have permanent rights to reside, or we can lend to them if they're residing in their home country. If they're residing in their home country, they would need to have a footprint in the UK, not necessarily a property. That could be a bank account or a limited company that's already been set up here. With expats, again, if they're looking to invest in the UK while they're outside of the country, they would need to be a homeowner in the country in which they're residing. But if they've already got investment properties here and they're either looking to refinance them and enhance their portfolio, that would be absolutely fine. So just coming on now to kind of complement the wide variety of borrowers that we'll lend to, we also consider lending on a wide variety of property types. So you'll see there we've got new build flats. We have no restriction when it comes to new build flats. We can lend up to our 75% offering up to 15 million. We probably will be looking very closely in the current climate as to where the flats are located, just to make sure that that area isn't kind of oversaturated and suffering with a lot of properties there that aren't selling. Serviced accommodation is another one that we are happy to consider, but again, we're probably taking a more cautious approach because there are quite a lot of properties in large city centres that will be empty, which are not being used for serviced accommodation at the moment, just due to lockdown. But if you have someone that has serviced accommodation, maybe it's a block of flats on the coast somewhere, or a holiday cottage that they run on a serviced accommodation basis, that's the kind of thing that we would say yes to. So it's really got to be somewhere that you yourselves or your clients would actually go to for a holiday, rather than just a one quick night overnight stay that's more related to business. Holiday lets, that ties in nicely with the serviced accommodation. So that's your actual holiday lets, where again you've got that property in a good holiday let location. We can see that obviously it probably would have been empty over the last couple of months, but going forward is probably really strong with bookings, as a lot of people are now going to be holidaying in the UK rather than going abroad. And what we would ask on the holiday lets is that they don't have a restriction just to be used as holiday lets. So if they can actually let as a family dwelling on an AST, that's what we're looking for. And it just gives us a bit more comfort as a lender, and the borrowers too, that if we're ever in times like these again, where the holiday lets are vacant, they've actually got dual purpose and could be rented quite easily on an AST basis. Purpose-built student accommodation, we are looking at those on a case-by-case basis at the moment, just because there's still quite a bit of uncertainty about the universities and what the intake is going to be for the next year. So that's definitely the kind of scenario where I would run it through specialists first to see whether or not it is something that we're able to consider. If they've already got agreement in place with the university for the next couple of years, but the security itself, again, doesn't just mean it can only be let to students, it could potentially be let to professionals as well. We're going to get much more comfort on those kinds of deals, because if the student uptake at the university isn't so good, but the properties could be let to professionals, then obviously we're covered and we're protecting the borrower as well. Low rental yielding properties that often you will see in more city centre locations. So quite often London properties, high value but a low rental yield, but they still make for a good investment. If you've got a really strong borrower that has got outside income, either from a limited company or being self-employed, we can look to take some of their additional income and use that to top up the low yielding properties to get them to the lending level that they require. That again is done on a case-by-case basis. Very simply, we look at the income and expenditure of the client, and whatever surplus income they've got left over, once all their expenditure has been deducted, is what we can look to apply back. DSS tenants, so if you've got security where DSS tenants are in situ, we're happy to lend there. What we're looking at is potentially tenants that are on low income, so maybe they are on income top-up, income support, maybe housing benefit. Those types of tenants we're happy to lend to, but anybody that could be deemed as being vulnerable in any way, that is it, that those are tenant profile types that we can't consider lending to. As a lender, obviously what we don't want to do is take back a property where there's vulnerable tenants in situ and have them kind of end up on the street. So DSS fine, but vulnerable, no. Freehold blocks, so multi-unit freehold blocks, we can lend any number of flats under one freehold title. We don't restrict there at all, and that's the same with our HMOs. So HMOs, any number of rooms within an HMO, we've got no restrictions there. what we do ask for is correct planning and licensing to be in place. So that kind of gives a really nice overview of the different types of residential properties that we'll lend on against the different types of borrowers that we'll lend to. For this, for all these types of properties and for the types of borrowers that we lend to, we don't load our rates in any way. So the rate card that you see from ourselves is a one rate covers all, so it does cover all these scenarios. So quick recap there, we can lend up to 75% LTV with fees added above. We have a 2% arrangement fee, which again, we can add to that 75% as long as the gross loan covers, and all our rates currently are 2 or 5 years. We've recently launched a product, it's called a 5-2 product, and it's a bit of a hybrid between the 2 and 5 year fixed. So it's a 5-year fixed rate where the rental is calculated on that 5-year fixed rate, but it only comes with a 2-year tie-in. So if you want details on that at all, please do have a look at our rate card or contact the guys as specialists and they'll be able to talk you through it. Great product for these uncertain times. If people aren't sure whether they're going to hold their investments long term, maybe want to come out of them 2 years time, that gives them the flexibility to walk away without any penalty. So just moving on to our semi-commercial. So all those borrower types that I mentioned also apply to our semi-commercial offering. Again, we can lend up to 15 million, up to 75%. We can consider either interest only or capital repayment, and we do offer up to a 30-year term. Manual underwriting again, so we try and take a holistic view of the borrower and the property to kind of make the right decision for us, you as the broker, and obviously the borrower too. The main quirk for us on our semi-commercial is that we need at least 60% of the overall pounds value of the property to sit within the residential part. What that actually means is we can work where properties are more heavily weighted on residential, and what that does is keeps our pricing a little bit lower. So all our semi-commercial rates start in the 4s, so we're very competitive there. This works really, really well if you've got, for example, 2 or 3 flats above a commercial. You'll know that obviously in that instance, it's more likely that most of the valuation is going to be held within the upper residential part. And on the left-hand side there, what you'll see is the types of businesses that we will allow to occupy the commercial part of the property. So quite a long list. There's not many that we actually say no to. So anything from offices, shops, restaurants, takeaways, fast food outlets, hairdressers, beauty salons. We can consider lending where there is maybe a bar or a pub underneath, especially if it's a city centre location, not on an owner-occupied basis. So if there's a lease in place and someone is actually renting out and using it as a bar, that's absolutely fine. Obviously, what we'll be doing is relying on the valuer's comments when it comes to marketability and saleability. Worth noting actually that if you're looking to place a property and it's flat, sold off on a long leasehold that is situated above a commercial premises, then again, we don't restrict on the type of business that it's located above. So again, what you've got there is your fast food outlets, your takeaways, your restaurants. We can consider lending on flats above those. So just moving on to the last part of our lending, that is our residential and commercial bridging. And where it says commercial bridging, what we mean there is it is more semi-commercial. So although at the moment we could consider lending on a fully commercial property as a bridge, the way we kind of underwriting them right now, just in this current climate, is that it would need to work with ourselves as an exit, just so that we've got a bit of extra comfort for the borrower and yourself, so that if they can't find their desired exit, it could still flip to an exit with us. So what people are generally using us for on the bridging side of things is for auction purchases, or maybe where they're looking to do some works to a property that obviously we wouldn't allow on a term. They could potentially put it onto a bridge and then complete the works to the property and then flip it onto a term with ourselves. We can consider lending up to 75% LTV gross, so with all interest and fees rolled up. We offer dual representation from solicitors that are on our panel. You have a dedicated case manager and underwriter, so because we understand that short-term loans and bridging obviously is requiring a much faster turnaround, that comes out of our standard underwriting queue and goes to a dedicated underwriter who is very specialist in bridging and short-term lending. We aim for 21 days from application to completion. We have been pretty much managing to stick to that throughout COVID. I think the only time where we do come against issues is when a valuer actually needs to access the property and just getting that access. We don't have any ERCs attached to our short-term loans. We do charge a minimum of 3 months interest, but there are no ERCs thereafter. We can consider up to a 24-month term with interest roll up on the residential, only 12 months on the commercial. So then just to move on to, again, give you a few examples of where we're seeing our bridging and short-term lending being used. Generally on a refurb to term or a refurb to let, where they're obviously are looking to hold that property. Maybe they bought it at auction, it was a single family dwelling. They've gone in, they've done internal works to turn it into an HMO, they've got the licensing in place, and then they're going to turn it out, retain it and let it as an HMO. That one works really, really well for us. Auction purchase again, so obviously they've paid their deposit and they just need to complete on that transaction really, really quickly. And the exit could either be sale of a property, maybe develop the finance if they're looking to develop the property and it's a bit too heavy for what we would allow on our bridging short term, or traditional bridge, they just need the money very, very quickly for something, but actually it works either with ourselves or maybe they've got another lender lined up that just can't do things quickly enough to act as the exit, so we can kind of step in the middle and get them to where they need to be. All right, and this just kind of gives you a bit of an overview of where we are in terms of pricing with regards to our bridging. So we are quite competitive. Rates actually start from 0.55 up to 0.65 per month, and that's up to a 75% LTV. We'll allow the 24 months term. We can go to 75% net. Dual representation, which really speeds that case up. No ERCs, again 2% arrangement fee, exactly the same as the rest of our term products, and dedicated underwriter, which really does help to speed the case through the process. Moving on to helping speed up the progress of an application, what we've actually got there is ways in which you can probably help the borrower and specialist when it comes to speeding up the application, moving through the process. Very, very simple things, on to detail, making sure that we've got correct names, spellings, address, dates of birth. You'd be surprised. I had a case that came over yesterday and the year of birth was actually 20. So obviously there was a mistake there that had been input, but then we have to go back to the broker, find out what the correct date of birth is, and then obviously it has to come back to us via specialist or whoever you're submitting through to progress that case. So we probably lost a day on that one, just with backs and forwards of something so simple as the date of birth not being correct. Later on through the process, which generally tends to hold things up, will be things relating to EPCs, regulatory compliance that relates to the property, and occupational leases. They're all things that we find hold up the legal process, and the solicitors have to redraft leases, etc., etc. So if you do have copies of them that you can submit to specialist for the case for us to review early on in the process, then it can help to save issues later and will speed up the application going through. So a quick overview there of where we are. So 15 million lending per borrower, 75% net with arrangement fees being added on our term products, no maximum age, no minimum income, and then the simplistic product range of just 2 and 5 year fixed with the addition of our 5-year product with just the 2-year ERCs. Our rate cards are priced to 5 million, and anything above that you can come via specialist for bespoke pricing, and we don't have any loadings for all the different borrower and different borrower and property types that we lend on. Okay, over to you for any questions. I'm going to plug my earphones in back in, Tony, so I can hear you.
Absolutely fine. Thank you, Sammi. Thank you for, I mean, you did it a bit quicker than last week, which is very kind of you, because we are slightly behind. So I do have Wayne Unsworth has asked a question. It says 1 SPV, what income required from client?
We've got no minimum income requirement, so even if it is in an SPV, provided they're not a first-time landlord, we don't have a minimum income requirement. All we're going to ask for is that it makes sense. So we're going to look at their income, look at their outgoings. Does that support one another? And we will ask to see proof of whatever they're declaring to us.
Okay. Warren Pesh has asked, does your criteria apply for Scotland?
No, unfortunately, we only lend in England and Wales. We don't currently lend in Scotland.
Okay, that's the same for many lenders, unfortunately. That's probably why we don't do a lot in Scotland. Okay, I've got a question. What is the maximum age that HTB will lend to?
As I kind of mentioned in the presentation, and people still say to me, are you sure you don't have a maximum? And yes, the answer is we really do not have a maximum. So potentially someone could come to us at the age of 90. If they've got a portfolio, we're happy to lend on that. What we would be looking for someone of that age is for them to have a succession plan in place. We don't necessarily need to see evidence of that, but again, it just needs to make sense. So it might be that he's starting to potentially bring one of his family members onto the portfolio for tax planning purposes. But as long as we know that there are family members in the background that are probably going to take that portfolio on, we can consider lending at any age. Okay.
And Neil, sorry, my glasses are a bit dirty, so I can't read the writing. Neil has asked, I can't read his surname, unfortunately. Do you lend on B&Bs?
No, we don't, because we would consider that to be a trading business. And at the moment, we're not lending on anything that is fully commercial. So that would come under the same as hotels, guest houses. They're all a no-go for us at the moment.
Okay. Okay, no more questions. There's nothing coming up. Okay, so as I mentioned on the previous Martin from Step 1 about the products being up on our website, as of today, it would have been today, but unfortunately my IT guy who was doing this yesterday has taken a day off to go fishing, so he's back in tomorrow. But he has promised me that all the lenders' documents will be up by tomorrow, so we will email you just details. So, but one of the things that Sammi has agreed to do is that if you wanted to speak, if you don't have an agency of HTB and you wanted to ask a question, but you wanted to ask the lender direct, she's happy to do that as long as you just quote Specialist Hub when you phone her, just so she knows, because if you haven't got an agency, then she normally wouldn't speak to you for obvious reasons. But she's more than happy to do that. So we're expecting her to be inundated with telephone calls on her mobile 24/7 from now on. So, but I haven't got any more questions coming up. So Sammi, thank you very much. We're only a minute behind, so okay, so I'll introduce our third speaker, which is Chris Buckley from Hope Capital, who I can tell has maybe been spending some time in the sun, either that or they've changed the lighting in the Hope Capital offices. It's one of the two. Let's get my clicker. It's decided not to work. Okay, you should have received, now you actually will have only received one of these documents, because unfortunately the product guidelines for brokers that you can see there, Chris did a presentation about 3-4 weeks ago, and we cannot find the product guideline for brokers that particular version anywhere. So we're still searching our system for it. So once we do find it, we will send that to all of you. So apologies for that, but we have searched everywhere. We don't know what's happened to it. So but we'll find it eventually. Just a little bit of an introduction for, first of all, Hope Capital and Chris. Hope Capital, one of the longest established, most experienced specialist bridging lenders in the UK. Strong reputation, providing a broad range of bridging finance solutions, even when others can't, and delivering on time. What sets them apart is their common sense, collaborative and transparent approach, competitive product proposition and dedication to service excellence. They are completely transparent about all fees, interest rates and the process right from the outset. Chris has been a BDM with Hope Capital since the spring of 2019. In that time has worked with countless brokers and helped facilitate millions of pounds worth of lending. With a wealth of experience and a drive to succeed, Chris provides an exceptional service to brokers and always seeks to find ways to make a deal work. And his interesting fact, Chris is actually half Danish and is fully fluent after living there for a number of years as a child. He will be doing today's presentation in English, you'll be pleased to hear. I will now put on Chris's slides. Chris, over to you. Can you hear us? Chris, still
unmuted there. Yeah, I can hear you.
Oh, great. Okay, I'm thinking, okay, another phone call. So, right, it's all over to you, Chris. I'll go on mute and silent, and away you go.
Okay, thanks, Tony. Thanks again to Tony and the team for giving the opportunity to obviously present today. I'll just get straight into it and obviously, refrain from speaking any Danish so everyone can understand. Obviously we've just run through initial reasons as to why you use bridging finance initially. There are many different reasons why, but one of the main ones is use property purchase at auction. So obviously completion days range from around about 21, 28 days. They did extend that out over COVID and everything else. Sort of back down to 21, 28 days, even though a lot of the auctions now are online. So we can, that's a sort of, we want to lend the money quickly. That's what we're all about. It's all about speed, efficiency, and being able to finance your clients' deals in the quickest possible period. We have had one complete since we've been back since lockdown in around about 7 days. So again, we're all about the speed to do that. Another main reason is we've got properties that are unmortgageable potentially, or they will be, dilapidated, and it's something where somebody would have tried to get a term lender, long-term lender, to be able to do it, and it's come back as too much damp, or there's issues with the structure, anything like that. That's where we can step in. And again, if somebody's paid 10% at auction for whatever reason, they've not maybe done their due diligence correctly or whatever it might be, we can step in and fund the rest of that purchase. We'll also do sort of equity release or capital raising on any existing properties that they own, and again, it's pretty much for any purpose really. So whether it's to pay a tax bill, pay outstanding debts, whatever it might be, we can raise for pretty much any purpose on that. And then the exit would be a long-term lender if the client's heavily adverse, which we will lend on as well. So again, potentially being bankrupt or they've got repossession orders against the property, we can step in, pay off their existing lender, stop that repossession order. But if it is at that stage, sometimes the exit that we will allow may only be sale of the property, not actual refinance. But obviously, it stops a repossession order, and it stops them losing the equity in the house, because they can then buy themselves 12, 18 months, which is our maximum term to allow them to sell the property. We'll also refinance existing bridging finance. So again, especially with COVID, you get a lot of lenders where they've started the bridge last year, and then obviously due to planning issues, planning departments have been particularly affected by COVID and people having to work from home, or builders not being able to carry it out, and a lot of those lenders now calling the loans in. So again, we can step in and do a refinance of an existing bridge. A lot of lenders won't do rebridges, but that's something that we're happy to do. There's a small rate loading, 0.05. But yeah, that is something that we're more than happy to do. Again, we've got off-market opportunities whereby somebody's maybe selling something that's not currently with an estate agent or, you know, on an auction, but it's a private sale for quick reasons, whatever that might be, whatever the vendor's reasons are. We're happy to step in and get that done quickly, and obviously therefore achieving you know, a lower purchase price potentially for the client. Again, we'll also do a lot of bridges for non-standard banking criteria, so that's such as foreign nationals, BVI company lending, offshore companies, and also change of use. So again, if we've got certain clients who are, they could potentially be a foreign national who've got other properties in the UK, or they've got bank account in the UK, they've got investments business in the UK, then we're more than happy to do that. There's a number of countries that we can't help somebody in, but yeah, we'll always look at every single deal, and that is the main thing with bridging, is just that the deals really, and everything's referred on a deal by deal basis, and if it's outside of our criteria, we're happy for people to look at it. So we will look at all of the deals. So moving on to why we're different. So just a little bit of a background to Hope Capital. We're privately funded, and we'll lend up to from 50,000 is our minimum loan. We've just reduced that from 100,000 to 50,000, right up to 5 million on term up to 18 months. So it's short-term, first charge, unregulated bridging. So we're not a regulated lender. So we can accept all applications in sole name or limited company name from regulated brokers, but in some instances we have unregulated or brokers or introducers, in which case it's just limited company apps that we can accept there. Now, regardless of what the type of deal is, more so since lockdown, we're pretty much looking on a lot of the deals that are outside of our criteria on a case-by-case basis. So we'll have the chief exec, Jonathan, and the MD, Gary, that they will be able to look over, along with Tracy, our head of sales, anything that's outside the criteria, and we truly look at everything on a case-by-case basis. So if it's an unusual case, a tricky case, we always try and find a solution to be able to get the deal done. You know, we've got funds here that we want to lend, and it's just a case of sending it in, no matter how weird and wonderful the case might be. I think that's the main thing, really. It's just to get it sent in, let's have a look at it, and then hopefully we can help you and your client out. We also completely transparent with all the fees and everything else that we charge, interest rates, everything's discussed with the client on a video call when they progress the application. Our AIP and application and formal terms will always state exactly what the fees are that they pay. There's no upfront fees to pay whatsoever. Once they decide to proceed, then they will pay the valuation panels, which we'll come on to in a second. But again, that is just paid directly to the surveyor. We don't take any funds or extra costs or anything like that. It's all paid directly to the surveyor, and yeah, there's no upfront charges at all. So unlike other bridging lenders potentially that you may have heard of or use or not, this is all we do is first charge bridging all day. You know, day in, day out. We don't do second charge bridging, development finance, term lending, second charges, anything like that. It's just solely first charge lending, and we feel that we're specialists in the field. We've got the experience in the office here to be able to progress deals that may perhaps can't be progressed elsewhere, and that's pretty much what we're all about. So it's just really being specialists in what we do. So I will then sort of 6 reasons why you could use Hope Capital. The main one that we have really is our service excellence. Like I say, speed and transparency of Hope Capital. We pride ourselves on our service, being able to get back in touch with brokers and clients if it's progressed to application stage very quickly. As I said at the beginning, we don't want to sit around on applications for weeks on end. we want to get it done so you can go back with some, go back with some concise information that's definite to the client to say, yeah, these guys will do it, and these are the terms that they're willing to offer. What we don't want to do is obviously have any confusion or you wasting your time. Your time's the most valuable thing, really, and we don't want to waste anybody's time, the clients or yourselves, with things that we may or may not be able to do. Just want to come up with a definite answer, and obviously if it's presented as it is, then we hopefully we can progress and look to complete very quickly. So yeah, we have the ability. So outside of myself, there's Tracy, who's head of sales, and then we can just refer everything directly to Gary and Jonathan, and they make all the decisions. Because we're privately funded, they can decide what we will and won't do, but very flexible in what they want to do. So again, comes on to point 3, where principal lender, we're not bound by any constraint to the high street lenders. We will look at everything on a case by case. We're not, even though we have a criteria list, which Tony's just shown you, that it's not been sent out, but we will get that resent back to Tony so he can redistribute it. But yeah, if there's something outside that criteria, happy to look at that. We've got many flexible payment options. So we've got retained interest, where everything's kept by us up front, and then obviously it's just repaid on the redemption of the loan. We have fully serviced, any mix of serviced options, so we can have partially retained. So if it's a 12-month deal, for example, we can retain 6 months interest, service 6 months interest, but we can have the payment to that. Instead of them starting in month 7, they can start in month 1. So you have the 6 months interest payable over the full 12 months of the loan. So very flexible. It's all about knowing what's going to be important to the client in getting them to proceed, and so that they're comfortable with the deal, obviously, and that they can afford it. Now, we can either use the income on serviceability from the property, or we can use it from their private funds or their self-employed income, investment income and such. So as I mentioned before, we've got an experienced team here. It's right from the owner with a surveying background. Gary, who is MD here, and other bridging lenders for many years, and then most of the staff here are all, ex-banking, finance, brokers, etc. So we feel we've got knowledge, extensive knowledge over the entire market. And then we'll lend on any type of residential investment property, commercial, mixed use or semi-commercial, HMOs, and land with and without planning. We just started lending more aggressively on land. That was the sort of last funding line to open after the COVID. But yeah, we're doing back on land now. So that is the 6 reasons really to use Hope. So now we'll move on to lending criteria. So this is obviously just a glance, and as I've mentioned a few times now, we will look to go outside the criteria if the deal is right. So if it's a strong client with a strong exit strategy, we can look to do that. We've got discounted rates from 0.54. That's on serviced rates, where it'll increase after 6 months. And then we've got standard rates from 0.83. So we have no exit fees whatsoever for standard bridging finance. And we also offer 0 lender fees across the board. So that will result in a rate increase. However, it can help if your client needs to net more day one. So if they need to net a little bit more, if they're tight on loan to value, we can decrease the arrangement fee, which our standard arrangement fee or facility fee, as we call it, is 2%. Which is deducted from the loan advance, but we can reduce that to 1% or 0% with the, it's just about the flexibility again, and being able to, do what we can to be able to make the right deal for the client. There's no set way to do it. It's just whatever's going to be suitable for the individual client. We'll do terms from 3 to 18 months. Now, if it's a really short-term thing and it is genuine, just a bridge for a month or 2 months, we can look to, the client can redeem after 1 or 2 months, but we will retain 3 months interest as a minimum. Anything over 12 months would need to be serviced unless there's a good reason not to. But we have done 18 months fully deducted up front, just to allow for things like planning applications or sale. If it's a sale of a particularly individual property in a location, maybe not your usual property that needs a longer sale term, then we can potentially agree that as well. So if somebody's developed the property, and again with COVID and everything else, if it's taken too long, we can then look to we can look to fund them to pay off their existing bridge or development finance and allow them to sit on the market for as long as they need, providing it's under the 18-month maximum term. And we're getting to see quite a lot of those now, because the existing bridge and finance or development finance are calling the loans, even though they've only just finished, because obviously COVID's added 6 to 9 months onto everybody's expected for property development. So we'll go maximum 75% on residential investment property. So again, a lot of lenders aren't doing up to 75%. They'll do to 70 or by referral over that. So yeah, we'll do that. And then again, HMOs, we're at 70% LTV, and it's just increased last week. So it's constantly changing after lockdown. Is that our criteria is loosening, and the rates are increasing. The rates are decreasing, and the loan to values are increasing. And like I say, land, we're starting to lend a lot more on that now. So we'll also do another one, that the last point on this slide here is that the refurbishment funds that we'll do up to 100%. So again, if you've got a client who is looking to purchase a residential investment property, do it up, flip it, sell it, put it back on the market, we'll do up to 75% on the purchase, and then we'll also fund 100%. So if they're putting in new kitchen, bathroom, flooring, heating, etc., we'll fund 100% of those funds in staged drawdowns in arrears. So by arrears, what I mean is if they've got 100 grand to do up a property, we could do 4 lots of 25 grand drawdowns in arrears. They spend the first 25 grand. We have an updated valuation or an inspection, or even in this day and age, we can go with photographs, receipts, and an update report, and then we can look to release them based on that, the fund, and then they would just use that same 25,000 again and again, so until we get to the 100,000. So that just helps with builders' costs, and then people who are doing renovations tend to have 2, 3, 4 projects on at the same time. Just helps with the cash flow. So that's something else that we do, which is very very popular. So moving on from the criteria, first stage. So as I mentioned before, we're capital raised for pretty much any business purpose. So like I say, even if they're in trouble with the tax or whatever it might be, we're happy to raise on capital raise as long as it's first charge. Also, we've got any credit status is considered, so we'll go from light right up to heavy adverse. And again, we even if they've missed the last 12 months mortgage payments, as long as they make the last one, we're happy to lend to them up to 65% on residential. But again, if they've missed, I don't know, 4 out of the last 24 months payments, we're still happy at 75% loan to value, as long as there's an explanation. And we've just done one last week where someone had a CCJ of 237,000. So I don't think I've come across such a high CCJ, but yeah, that was one that we did last week. Again, there was reasoning behind it and everything else. So each case, like I say, is case by case. Normally, would have just dismissed that out of hand, but obviously you have to have a look at the circumstances individually. So as I say, that we're just going over things that we've been through before. They were the foreign nationals and the serviced. And the last one, there's the we will come on to it, is the valuation models. So pre-lockdown, we were all about doing full rep-up valuations, which are lengthy valuations and can sometimes be a little bit costly. But obviously that was just the way it worked. And a lot of the time, if it's a non-standard property, you still got to do that. However, if it's a standard residential investment property, we can look to use different valuation models now, which we've brought in since we came back from lockdown. So that is things such as AVMs, drive-bys, desktops, and short form valuations. So the short form valuation is a little bit like what you'd see on a remortgage or a purchase on a term mortgage lender. So any high street lenders would use those sort of 1, 2, 3 pages because it is just a residential property in a terrace street or in a street of semi-detached houses, and we're happy to use that because we've got the history there. So again, they can be a lot cheaper and a lot quicker to do, and we'll have an example of that shortly. So yeah, on the first example, again, this was to do with using a residential property where we've used a different valuation model. So it was a residential property in Kent where they purchased at auction, and they needed to access the funds real quick. I think they'd gone through a process of trying to fund it elsewhere first, and they couldn't get those funds. And then they came to us, needed to complete in days. So obviously, because it was a standard residential and it was low loan to value, so 55% loan to value, they were putting in the rest on the purchase. What we're able to do is get the AVM model for the valuation to enable them to complete really quickly. So I think it completed this was one that was completed in 7 days, and obviously it just meant that the client didn't lose their 10%. They weren't charged anymore by the auction house, and it just enabled them to complete really quickly. Obviously the broker was really happy because he managed to get the deal done for his client, and obviously what we hope is it's a repeat client. Because that's what we want to do is obviously not just do the one loan with either yourselves or your clients. It's hopefully the clients come back. It's a good experience for them. You have a good experience using Hope Capital, and we can get people out of a tight situation, really just using the experience, flexibility and everything else that we possess here at Hope. So yeah, that is pretty much an example. There's one last example before we can field some questions. So again, this is to do with the serviced element, where we pretty much had a property was looking to purchase, get some light refurbishment works done. Again, with the refurb option, anything that's light to moderate. So if it involves sort of QS or need building reg sign off, we need to refer that and get that agreed. But anything else we can agree it here. It's not a problem for us to do that and progress the application. But by doing the servicing, we were able to get this client almost £4,000 more on day one, which gave them the extra funds towards that refurbishment project. So if you're choosing the flexi serviced option, they got monthly payments at £740 over 6 months instead of £1,480, which would be standard. So by playing around with the retained and serviced interest options, we can either reduce that serviced option to a more manageable amount of £740, which fell under what they were going to receive each month, instead of it being twice what they were going to receive in rent, and then having to go to their own private funds. So it's just about working different ways to get your client and what you need. But we try and send everything over and explain it in a way whereby it can be relayed back to the client, in a totally transparent way. So yeah, hopefully that helps everybody, and we can obviously field any potential questions. The last slide there, if you do get a copy of these slides, it just gives you the process that we work through. So again, it's all to do with the inquiry that we send over initially. Once that gets agreed, you get an agreement in principle. Client just signs the agreement in principle and agreement. Short application form of 8 pages to fill out. That gets sent in, gets agreed by underwriting. But obviously, if we get all the information correct up front, we should be okay, and then we can move forward to completion. So hopefully that helps everybody. And I think that's it, Tony. If you
one more slide, you got
field any questions,
which says there you go. Any questions, pretty much. So we haven't got any questions asked by any delegates.
No.
I do have a couple You've actually covered some of the questions already, so I'm just going to ask a couple here. Do you lend to previous clients that have been previously bankrupt?
We do. We just got to, even if they've been previously bankrupt 12 months, we're happy to lend. It's a reduced loan to value, but if the bankruptcy was over 3 years ago, then yeah, we can still lend up to 75% on a standard residential property. So yeah, we're happy with that bankrupts.
Okay, and has your lending criteria changed since COVID-19?
It has a little bit in the sense that we're a little bit lower LTV on commercial, and semi-commercial deals were sort of 60% instead of being at 65 and 70. But all the other, we did start off lower straight after lockdown at, let's say, 65% for residential. That's back up to 75% now. Land's back up. So hopefully, as we go on and we start seeing loans go out, and also more importantly for us, as we get some redemptions on loans, then the confidence returns, funding lines, and then they can relax, increase LTVs and reduce rates. So hopefully they should be coming in the next couple of weeks.
Okay, I haven't got any more. None of the delegates are asking anything. So, Chris, thank you very much for the presentation. Much appreciated.
No problem.
Appreciate it as always. Stay out of the sun. Get some cream on you.
Thanks, Tony.
No problem at all. Okay, so we're just going to move on to our final lender speaker. I'm just going to get up their introduction. Here we go, and we're now going to add him as a presenter. Kick Chris off, so we can add Luke. Here he goes. So we can add Luke, and okay, so here you go. So our final speaker from YBS Commercial Mortgages is Luke Douse. There you go. You should have received one of these in the post and by email, which is the YBS commercial. And Luke looks very different on camera, doesn't he, to that picture we just saw? So I'm just going to go back actually, just so we can see the picture. A little bit of a comparison there. So there you go. So obviously he still hasn't got around to having a haircut as yet from COVID, even that, or he's wearing a wig. It's one of the two. I'm not quite sure. I hope it's not the wig. So it's Luke's brother. Someone's just Carolyn. Thank you very much. So you should have received the YBS commercial mortgages. Now, just so you're aware, this condenses the three of the slides that Luke is going to be going through. So this has all the information that you need. So we did have some delegates last week who were asking if we could send them the slides, just so they could see the three slides because they thought they were different, but they're not. So our introduction on Luke. He's business development manager, not director, as I said earlier on. So you need to ask for a promotion, Luke, according to me. He's had roles in marketing as a relationship director and a broad range of experience, which he uses to support YBS Commercial Mortgages broker panel and wider business development activity. He has a keen interest in the commercial finance market and in relationship building to support YBS's ambitious growth strategy of expanding its award-winning product range and opening new regional offices across the UK. For those of you who don't know, YBS were previously YBS Commercial Mortgages, previously Norwich and Peterborough Commercial Mortgages. They've rebranded over the last year or so, and we're very lucky and fortunate and grateful for being invited onto panel. So, as far as Luke's interest, in fact, he loves surfing and visits Cornwall every year to hone his skills. Although this often means just perfecting the art of getting back on his board after he wipes out, I have never ever even looked at a surfboard in my life, I'm pleased to say, because I'll probably end up drowning myself. So I will now put on Luke's presentation, disappear for 15 minutes. Luke, over to you as soon as these slides come up.
Tony, thanks very much for that beautiful introduction. Yes, I have slowly grown back over the last few months whilst we've been enjoying lockdown. But if this hot weather keeps going, I might have to trim that right back. Real pleasure to be able to speak to you all today. Thank you. Just really want to give you an overview, focusing in on our specialist buy-to-let proposition. That's evolved for us over recent months. As Tony touched on, we were previously N&P Commercial Mortgages, changed over to YBS Commercial Mortgages, part of the Yorkshire Building Society in June last year. And with that, we've got some really ambitious growth strategies as we look forward over the rest of this year and beyond. as part of that expansion, we've always had one office in Peterborough, but we've now opened offices in Birmingham, Bristol, and Manchester to complement that and to give us that broader national position. We've always lent across England and Wales, but we find that having those localised specialist teams who know the areas and their regions is really a good win for us, and it's meant we've been able to attract some great talent to work on our deals. So looking at the products that we've got on offer, I'll start off with the corporate buy-to-let products. Now this is available to limited companies and LLPs. It's something that we've done for a number of years, but obviously it's an area of the market that's become more and more popular with tax changes and the rest that have moved into this space. So we'll lend typically to experienced landlords, predominantly people with portfolios. We're not lending to first-time landlords at the moment, but people with lesser experience can still be considered. We've also this year brought out these fixed rate offerings. We've previously done everything on the term tracker for a lifetime, but with the shift in the market and the way the affordability works, we thought that we would get involved with some strong fixed rates. So they're filters you can see on there. The headline would be the 5-year fixed rate up to 65% loan to value, and that's available at 3.35%. We can also take up 75% loan to value on a 5-year fixed rate at the 3.55%. And the crown jewel, as I see it at the moment, is the 10-year fixed rate that we have on offer. I'm not aware of any other 10-year fixed rate that's available in the limited company buy-to-let space at the moment, and it's just a shade more at 3.6%. With these offerings, you can see the broad details that are on there. The assets that we're interested in are houses, flats, multi-unit freehold blocks. We don't have any restrictions about the type of tenants that are in place on there. If it's led on a standard AST, we don't mind if they're on housing benefit or other areas. In part of the Yorkshire Building Society, we want to offer real help with real lives, and that means opening up to a variation of the different types of tenants that might be in place. So I can just bring across. As I say, many of our borrowers that come to us are portfolio landlords. We're a relationship-focused lender, so having people that can come on board and we'll bring them through the process and then be able to do future loans for them is a key part of our business model. We're very much in looking to control the relationship with the broker and seeing that's the most important aspect for us. So we're not ones to poach a client after they've done one deal. We're more than happy for the broker to stay engaged, come back to us and help us with that journey as we look to build on the way that we're lending to our customers. In the last few months, we've increased our exposure limits, which were previously £5 million across our limited company buy-to-let. We can now lend up to £20 million for an existing customer that's had a 3-year track record with us, but we will lend up to £15 million for a first-time borrower. And that kind of speaks to the sizable growth aspirations that we have for the business. We've had record months back to back, predominantly led by this product through the lockdown, but we're expecting future growth leading up to the end of this year and certainly kicking on even more into 2021. We'll find that often letting unit value, just to specify on there if anyone has any questions, so in the instance of a multi-unit freehold block, if we've got 4 flats, we could lend up to £4 million on that single title, because we'll look at the individual letting units that are in place. And that means that we've got more flexibility and loan amounts that we can look at can really broaden out to the market as well. As mentioned, it's standard AST lets, so no HMOs at the moment, but we can look to lend up to 12 flats in a single block. Now that could be an entire block made up of 12 flats, or that could be a block of say 15, 16 flats where we're looking to lend on 12 of those. Interest only comes as standard, and we're happy to add the arrangement fee on top of the loan. We do have the flexibility where we can look at part and part transactions or repayment if that's the customer's preference, but we find in 90-95% of deals that interest only is going to be what our borrowers are looking for. Just walk through into the large personal buy-to-let. This is something that's become really new to YBS. We've never worked in the large personal or personal space at all within the commercial team. Our sister company Accord has dealt with the higher volume levels of buy-to-let. What we're really looking to focus in on are those experienced borrowers with sizable portfolios that maybe aren't considering an incorporation because it doesn't work out from a tax perspective for them, but they're still looking to finance on those portfolios. The key area, we're looking for a minimum loan size of 1.5 million, and that must be across 6 properties. Or if we're looking at a larger loan size at £3 million, then we can do it on any number of properties, be that 1, 2, 3, wherever we sit on that. The rates that we apply on this and the loan to value caps mirror what we have in the corporate buy-to-let offering. So similarly, the 3.35, 3.55 and the 3.6 10-year fixed rate. We'll look up to 4 applicants, so we don't look at the style of mortgage clubs or more complicated setups than that. But we think that gives us enough scope to cope with most of the types of transaction that we've seen so far and that we're planning to bring in the future. Just to note, the stress rate with this being a personal buy-to-let is calculated slightly differently, and the stress test will be included on the handout slide that Tony will be able to share with you all. Just to point out, we will look for detailed valuations in these instances, and that means that we'll typically instruct a commercial surveyor who'll go out, visit the properties, inspect, and come back with a more detailed report, giving an idea of the location, the profile of the properties. That's something that we'll also do for multi-unit freehold blocks, be that on the corporate buy-to-let or not, and we will lend against a block discount value. That isn't always a huge level, and that's typically where we have 5 or more flats within a block. For a much smaller block, we may be happy to run a typical vacant possession market value that we're looking at there. I'm cantering on quite quickly, but hopefully it's a fairly straightforward proposition which ties into what we are looking at focusing in being a building society. For us, being able to understand our customers is going to be really key, and that means understanding the background from day one. We'll look to see the way that people have accrued their wealth, how they've attributed their deposits, and we'll really get to know and build that relationship with our customers. In any application, one of our lending relationship directors will be in contact with the customer. We typically have a meeting, but given the current circumstances, we're much more likely to do that over the phone at the moment. And it's not an interrogation, it's just a chance for us to build up that kind of background, build up some rapport with the borrower, and just really guide through the application so we can understand their strategy and set out with credit what the future might look like for them. And that means any repeat customer that we were to be brought by that borrower, we've got the background foundations are really strong, and we can look to kick on to really help them in their future property endeavours. In terms of new build flats, this is something that we weren't looking at previously, and again, it's a new feather to our hat. We consider newly built or properties that are newly converted to sit within this area, and we do cap lending at 65% loan to value for new builds. One of the key items to pull out here, it mentions about office to residential being unacceptable. The real appetite for the society is not to lend on large office blocks that have been converted and swapped into residential use. If it's an office with a flat or 2 flats above that were previously storage or an extension of that, that's something that we're more likely to take a view on. So feel free to refer anything that sits within that gap, and we'll be happy to look at those. Again, above commercial, where it mentions that it needs to be owned by the borrower, that relates purely to the new build element, and that's just so that we can manage to identify that there is going to be an ongoing demand for the residential use. In our typical product, we're happy to lend above commercial, so be that fish and chip shop, Indian takeaway, whatever it might be, where some lenders may have more of a difficulty with that. If it's an established unit, we're happy to take that on board because we can see that there's been a previous rental demand for it. If a borrower owns a unit above commercial, then if they've got control over that, we see that there's a greater likelihood that they'll be able to manage the tenants effectively so that there's no impact on the values to the new build element that come in. You'll see on here that, again, will lend up to 16 property containing up to 16 properties, but it still implies the 12-unit cap that we can have within that block. And ground rent's fairly standard, I would imagine, at the moment. We'll look for those to be at a reasonable level, so we don't want anything punitive that's then going to impact the ongoing value of the property as we go forward. Another new addition, this is Holiday Lets, launched over the last couple of months with us. It's a new space that we've moved into, and this is focused purely at limited companies, so no LLPs or personal borrowers in this instance. It's focused in on affluent coastal and national park locations, so that's many parts of the southwest, the Lake District, Peak District. What it's not designed for is to be used with the types of Airbnb city lets, whether that's a space we move into in the future, but for now we're looking at kind of real typical holiday destinations within England and Wales. Again, it's available on a 5-year fixed rate. Any type of transaction is available on there, and we will lend at 75% loan to value. The minimum loan size for the holiday lets is 500,000, which applies across the board as our minimum. So that's for corporate buy-to-let, personal buy-to-let, and the commercial elements that we run as well. And the key area that you want to look on this is the serviceability assessment and the way that we follow it. So we'll take the gross holiday let rental income, and then we'll less the actual letting agent's costs. So if this is an established holiday let and we have accounts and we have details to be able to support that, then the figures will work from. Otherwise, we can take a projection based on an agreement that's been made with the letting agent, or if we don't know at the time, we'll apply a 17.5% discount on the gross rent to start off with. We'll then subtract any business rates that are applicable, and that only comes in where there's 2 or more holiday lets for the investor holds already. And that gives the net income then to give us the 125% interest cover at a stressed rate of either 5% or pay rate plus 1%. So as we stand today, that is 5% stressed rate. Some of the other key criteria to fit in with this one, so we do allow owner stays up to 90 days in a year. So if there's an investor who wants to buy somewhere for their own use, we find there's a lot of people that still want to be able to enjoy the properties that they own. And because of the level of yields, we can allow a bit of time out from the year for them to be able to relax and enjoy themselves as well. In terms of the property type, so these are typical bricks and mortar style buildings, something that could be let as a typical family AST, for example. We won't lend against chalets or anything that has a kind of restricted occupancy, where they're open for say 10 months a year. It needs to be a typical residential dwelling for the most part, and it's just the letting format that makes it stand out as a holiday let to us. Again, we'll allow interest only for the full term, and there are options of part and part and repayment if applicable. We'll note something on here that's worth shouting about at the moment. Obviously, we know with lockdown that had a real impact on a lot of the letting market, particularly in holiday stays, people not being able to visit. What we've done is drawn a line under that. So if we're looking at historic affordability, we will look in the 12 months leading up to lockdown, where we'll assess that income, as opposed to leading into the months afterwards, where that maybe fell away slightly, should we say. Just to give you an idea of the exposures, as I'm going to say, these have been increased across the board, and these are cumulative levels. So up to £15 million for brand new customers walking in the door. The only time that's different is on our owner-occupied offering. So that's commercial owner-occupier, where we do cap that at £10 million, and that's purely because we find that most of our owner-occupied borrowers may well only have 1 or 2 properties with us at maximum, and it's just to make sure that exposure is relatively diversified, which we get in the other instances. We are looking to establish those long-term relationships, and I would view in the future that again and again we are going to see that increase in the exposure limits as we take them forwards. So that's a bit of a canter through. if you've got any questions, Tony, if there's anything you'd like to draw out, or if anything you'd like to ask about commercial property.
Okay, you haven't got any questions. I might just ask a question of all the delegates. So can we have a vote, please, for Luke for hair on or hair off, please? So just vote now in the bottom right corner, type your message, and you can then obviously let the public decide. In the meantime, what I'll do is we've got a couple of pre-prepared questions, obviously. So does YBS Commercial Mortgages have any plans to extend its product range, Luke?
Yes, we do, Tony. Thank you. So, in the wings at the moment, we are looking at an HMO product that's going to come out to complement the limited company and personal buy-to-let offerings that we've got at the moment. There's whispers that will be up to 16 beds within one unit, which is quite large in terms of the general market setup. So, we're still looking to refine that, but I expect over the next 6 to 12 weeks, we should have a product that's in place and accessible, and that'll complement in terms of a portfolio setup. So we may do an HMO loan alongside a corporate buy-to-let loan so that we can do a wider offering for a customer.
Okay, excellent. Second and last question I've got is, what is the process for progressing the loan through YBS commercial mortgages?
Fantastic. So at the moment, we operate a small selective panel of intermediaries. We're really relationship focused around the brokers that we work with. So for anyone on the call that has a transaction they'd like to bring to us, absolutely feel free to give me a call or drop me an email in the first instance if you'd like to discuss the headlines of a transaction. But we would ask that you come via the specialist hub for those deals to be placed. When a deal starts, we'll collect an application form. Sorry, Tony.
Go on, no, you continue. Sorry, I thought you finished. My apologies.
No problem. So in terms of the actual way that the customer will see it, we'll take an application, we'll give detailed indicative terms. We're always confident in those, but then they're not credit back to that time. We'll typically go to valuation first, get the details back. We're a bricks and mortar led business, so understanding that means that we can make sure that we're putting forward propositions that are going to be most complementary to the client. We'll have a meeting and then go through our credit process, which is 2 stages. So there's a customer due diligence sign-off and a credit sign-off, and they will be run concurrently going forwards. And that's just so that we're compliant with all our necessary checks.
Okay. As per the previous speakers, again, it will be tomorrow. We've got everything ready. All the documentation for YBS commercial mortgages will be on our website, together with the criteria for you to download. So we're trying to ensure any PDFs are editable, so you don't have to print them off and handwrite them. So we are trying to get into the 21st century of all of our lenders. Unfortunately, the marketing departments of some lenders aren't in the 21st century, which is always a problem. But we are trying to ensure it's as easy as possible. But as Luke says, if you do have anything that you believe might be for YBS, just give us a call. We can either offer the advice ourselves, you just pass it over, or you can offer the advice and we just act as a packager. But as he mentioned, it's a very limited panel and a very, very lengthy process to get on panel as well. So said before, we're delighted to be on panel. And Luke, just so you're aware, there aren't any more questions. So the vote is, and the voting is now closed, everyone. So it's for hair on, but we do have one vote for beard off. So
beard off. Thank you.
Beard off. So
thank you, Wayne.
Wayne obviously isn't that keen on beard, or to shave your head and turn your head upside down. Maybe that could be another option. But it's me personally. Hair on, I reckon. So yeah, keep it on. So looking good. So next time we see you, you'll have a mullet. So all good. Right, Luke. Thank you very much indeed. Much appreciated.